Okay, I'm going to break two rules. Number one, I hate PowerPoints. Number two, I hate reading a speech. I have to do both of these because I have so much information I have to try to get across within 30 minutes, and I really need to read my speech because the subject matter to me is so important that I don't want to leave anything out, and I promise you I'd gloss over it otherwise. So, thank you for being here. Let me just show of hands. Let's take a vote. We do one of three things. Inflation, deflation, no clue. Start with inflation, raise your hands. Deflation, raise your hands. I'm not going to pick on you. Oh, that's actually scary. There's only one of you? All right, I take that back. I'm a deflation guy. And then how many of, nothing personal.
I voted for
who in here has no idea? Great. This presentation is mostly for you guys because my ambition is to give you a framework to think about it. If I've accomplished what I hope, it's a framework that's not what you're reading over and over again in the popular press. Inflation, I think, now has gotten to be such a cliche debate. Trust me, I turn off to the subject matter at cocktail parties. I have no interest in talking about it. But I believe that if you come at it from a slightly different perspective, it will give you the tools to be able to track certain metrics so that you don't have to predict inflation, deflation. You can watch metrics and observe. In fact, the guy that I've done this project for is a big believer in observation, not prediction, and I think this is the perfect case. So is inflation in our future? I believe being on the right side of the inflation-deflation question could be the single most important investment decision of the coming decade. Although many people fear inflation may arise in the future, no one seems to believe that it's a problem today. I challenge this belief. Inflation is not in the future, it's in the present. It's been with us since at least the late 1990s. We just can't see it in CPI yet. So where is it hidden? How is it hidden? By setting the price of credit unnaturally low for so long, central bankers around the world encouraged the formation of excess capacity that far exceeded consumer demand, thereby keeping a lid on price increases. There are inflection points in history, and I believe 2008 was one of them. It marks a structural, not a cyclical turning point. The supply-side orchestrations of the past 3 decades are now over. The same tricks will no longer work. The past 30 years, therefore, are a terrible roadmap to extrapolate into the future. As the animal spirits diminish and the cost of capital rises, production capacity is now shrinking faster than consumption. The inflation from all the money supply growth over the past 2 decades will soon become visible to us in consumer prices. Before speaking about the present, let's take a peek at history, the 1970s, the time of what was called the Great Inflation. CPI had been accelerating during the 1960s up to what was considered to be at that time, surprisingly, an alarming level, 4%. The Fed tightened. Nixon replaced this chairman with his good friend, no exaggeration, Art Burns. Burns immediately and aggressively lowers the Fed funds rate. So here we begin in 1971. Now I want to emphasize that had we been reading the Wall Street Journal in the autumn of 1971 and carefully tracking the traditional metrics that most people watch, there would have been almost no indication that inflation was at hand. Notice, unemployment was rising, CPI was decelerating, capacity utilization was declining and was very low. This means that manufacturing plants had lots of unused production capacity, implying theoretically they couldn't raise prices. Velocity was slowing. So, just before the great inflation started, things looked, if anything, more deflationary than inflationary. But then this happened. Capacity quickly tightened. And important with this stat, this is actually a lagging indicator. You're looking at a figure that's been revised several times and actually can have up to a 6-month lag. So, but in hindsight, you can see how quickly capacity was actually tightened. Velocity snapped back as well. In response, the Fed quickly tightened, more than doubling the Fed funds rate from 4% to 10% within 18 months. Unfortunately, CPI, or inflation, was bigger than the Fed. Inflation tripled from 4 to 12% within a 2-year window. The stock market dropped 40% within a year. I mean, this is frustrating, right? Were there any metrics or signs that we could have been watching at this time that might have tipped us off that inflation was in the cards? My aspiration is that this broad framework that I'm sharing today hopefully might. Every inflation on record over the past centuries has been preceded by a government or king running deficits. The great inflation of the 1970s was no different. During the 60s, the U.S. began to consume more than it produced. This meant we were buying more from foreigners than we were selling to them. That's called a trade deficit. Dollar outflows in 71 showed an alarming deterioration, with the trade balance for the first time moving sharply into the deficit. I was just quoting Volcker. Foreigners began to fear that the U.S. would print money to finance its deficit. Indeed, by 1971, U.S. dollars in foreign hands were only 44% secured by gold. And this is before we officially abandoned the gold exchange standard. Fearing that we were debasing our currency through inflation, foreigners asked the Fed to trade in their dollars for the gold that backed them, which at that time they could. Now, even before this panic, the U.S. gold supply had already dropped 50% during the decade of the 60s. But in the summer of 71, as all the foreigners showed up to exchange their dollars for gold, the U.S. gold supply suffered an alarming deterioration. Again, Volcker's words. And so, a panicked U.S. president in August 71 announced what came to be called the Nixon shock. He announced that the U.S. was now ending dollar-gold convertibility and that we were going to begin a negotiated devaluation of the U.S. dollar. And since he knew a devaluated dollar would drive up foreign good prices, thereby creating inflation, Nixon announced sweeping price controls and wage controls across the entire U.S. economy. Next time a friend at a party talks about how socialist the U.S. is becoming, talk to them about 1971. U.S. businesses could not raise prices or wages without first getting approval from a commission in Washington. These emergency price controls were supposed to be in place for 3 months. Go figure, they ended up lasting 30 months. Deficits lead to temptation. Now that Nixon was off the gold exchange standard, and now that price caps were in place, his Treasury and his Fed could work their magic. But let's pause and take a brief step backwards for a little perspective, the period of time before we were overtaken by this temptation. Between the mid-1940s and the mid-1960s, our money supply, which is the green line here, grew roughly in line with the real economy, the blue. Theoretically, if our Federal Reserve wants to achieve stable prices, it should aim to have the money supply grow in line with real GDP, holding velocity constant. During the 60s, the U.S.'s ambitions swelled faster than its wallet. The Great Society, Apollo 1, Vietnam, these things cost money. Between 1960 and 1970, our real economy grew by 54%, but government spending grew by 127%. Fiscal and trade deficits were at the dawn of becoming a serious issue. So what to do? Raise taxes? Cut spending? Or use fiscal and monetary stimulus to grow the money supply? As Mark Twain once said, I deal with temptation by yielding to it. And so we did. Here you see that the money supply growth began to outpace the real economy in the mid-1960s, even while, note, we were still in the gold exchange standard. This was accomplished via lowering the Fed funds rate and lowering bank reserve requirements, thereby stimulating the bank multiplier effect. After the Nixon shock of 71, gold was no longer an anchor to our reserve-based banking system. So from there, it was off to the races. CPI, by the way, because of the price controls, in 1972 was only 3%. So in retrospect, these price controls successfully contained the appearance of inflation during 1972, but government can't mandate prices. They can't eliminate intrinsic inflation. As these controls began to expire between early 73 and early 74, prices naturally readjusted to their natural levels, which created a pronounced acceleration or catch-up surge in prices. These artificial controls had another unintended consequence. They discouraged producers from producing. Rather than produce something and sell it at a loss, many chose not to produce at all. Naturally, this led to shortages. During 1973, some price controls began to be loosened or abolished, though some controls remained in place in certain sectors, which included, by the way, food processors and grocers. Food was a stubborn problem. Even with the price controls in place, food CPI in Q1 73 was up over 10% year over year. The combination of price controls, subsidies, and regulations were discouraging farmers from production, and a spate of bad weather made it worse. There were shortages. Food CPI clocked in at 20% in 1973. Then oil prices jumped fourfold in 6 months. This was the Iran, this time was the Yom Kippur War and OPEC. So with gas and food prices spiking up, a classic wage price spiral began. Labor demanded higher wages to cope with higher food and energy prices. By the way, it's worth noting that the energy price controls, many of them remained in place until the 1980s. Nevertheless, we got another supply shock later in the 70s. I'm skipping over. There was kind of a brief period of calm. In the interest of time, we had another supply shock in 78, 79. Food prices rose over 10% a year and oil prices doubled. So after calming down, things got bad again. Now, if we look at the inflation as a whole, during the 1970s, you actually see it was a series of three successively bigger inflations. And it was only after this third inflation that the public, the American public, garnered the will to make the structural changes necessary to eradicate inflation. So, what broke inflation? These guys. In 1979, Carter finally realized that inflation was a political liability. Voters cared. Now keep in mind, he had been voted into office with a very loud mandate to get America back to work, to shrink unemployment. Inflation was not, it was an issue, but it wasn't number one. It was unemployment. 79, inflation was at the top of the list. He makes a bold appointment, Volcker. People knew who he was back then. He had a reputation. Under Volcker, the Fed abandoned the Phillips curve, which is the notion that there's a manipulatable trade-off between inflation and unemployment. More importantly, he made a major tactical shift in how the Fed conducts monetary policy. He shifted the Fed from explicitly setting the level of Fed funds to instead explicitly setting the money supply. Heretofore, the Fed had set the price of money and let the market determine the proper money supply for that given price. The problem was the Fed thought that inflation was this, and it was really this, because you're looking at past data. So he was constantly behind the curve. He essentially could, or the Fed could never catch up with inflation. So Volcker's change meant that now the Fed would set the money supply and let the market determine the appropriate interest rate for that supply. But as it turns out, the market price is much higher than the Fed thought. Fed funds spiked to 20%. The Fed was finally able to get ahead of inflation because real interest rates reversed from being sharply negative to being sharply positive. Real interest rates hit an all-time high. It induced a recession. We tamed inflation. Most importantly, the public gained confidence that the Fed was serious about fighting inflation. Then, in 1980, Reagan was elected with a loud mandate to shrink government. So here's a picture of real interest rates, and this is essentially just Fed funds less the CPI. And you'll notice that during the 70s, we had several periods where real interest rates were sharply negative. This means that assets were inflating at a much higher rate than the cost of money, cost of borrowing, which effectively encourages speculation. The Fed was basically paying you to borrow money and invest. Note, too, that this same situation existed between '02 and '04. And go figure, folks took the free money and built Florida condos with it. And of course, you see we're doing it again today. Is there any wonder financial markets are booming around the world? So what did the 70s teach us? There's more to inflation than money supply. Things can change very quickly, especially velocity and capacity. Even a smart, hawkish Fed can fail. The mandate of the people matters, and government fixes inadvertently discourage producers from producing. Can inadvertently. So if you look at all inflations through history, there are several common themes. Simplistically, big inflations are associated with budget deficits, money supply growth, and shortages. That last one was news to me. Hyperinflations are almost all associated with big shortages. We're not talking about hyperinflation, nor, so I'm not misunderstood in any way, shape, or form, do I think a discussion of hyperinflation for the U.S. is even relevant right now. I'm not predicting that or implying that at all. That, in fact, is completely unknowable until you see the policy response once we get to a modest inflation, if that ever happens. So, moving forward, the Great Moderation from the 1980s, the 1990s, and the 2000s. Now, the key takeaway from this slide, of course, is that no matter the advances in technology, cell phones are still damn annoying. So, with inflation whipped, 1982 marked a secular shift in the U.S. and global economy. Keynesians were out, monetarists and supply-siders were in. And I mean literally in the White House, in the Treasury, and ultimately, when Greenspan came along, in the Fed. The new attitude in Washington, very pro-business. Lower taxes, easier regulations, free trade. Now, we're going to take a diversion here, and I'll come back to where this is relevant in just a second, but it's an important diversion. In the old days, people put their savings in their corner bank, which used these funds to invest in government bonds and make loans. Banks were intermediaries between those with excess capital and those in need of capital. But things changed in the 1980s. Banks were disintermediated by Merrill Lynch and Fidelity. Savers bypassed their corner bank and instead placed their savings with stockbrokers and mutual funds. Naturally, stock and bond markets responded very well, which created somewhat of a self-fulfilling prophecy. Savings that once flowed to the corner bank, which in turn had flowed to small local businesses and real estate purchases, now all of a sudden flowed to New York and Boston, which in turn flowed to large governments and business enterprises worldwide. This is a critically underappreciated aspect. There is a critically underappreciated aspect of this change in savings behavior on the part of the retail investing public. It directed financing to larger and more global entities, which then invested these proceeds in ways that dramatically accelerate the growth of global production capacity. Now, everybody knows that printing a lot of money or growing the money supply creates inflation, right? Well, it depends. If we double the amount of money in circulation, holding everything else constant, prices should double. There'd be twice the money chasing the same quantity of goods. Clearly, that's inflation. But what if the money supply doubled and the quantity of goods also doubled? There'd be twice as much money chasing twice the supply of goods, so holding demand constant, there'd be no inflation. This is essentially what happened over the last 30 years. Our money supply has grown dramatically, but our production capability has far outgrown our consumption. So much so that it has largely anesthetized the otherwise inflationary impact of our growing money supply. Now, talking heads blame the consumer for spending too much, but you hardly ever hear anyone complain that producers are producing too much. Yes, consumption has grown over the last 30 years, but not by the same magnitude as production capacity. Supply has been outpacing demand. And so, as you can see in this chart, between 1982 and 2000, during the Great Moderation, investment in new capacity, the green line, grew much faster than did personal consumption. In the early 1980s, supply-side economists invaded Capitol Hill. Washington's playbook pivoted to stimulating supply. Taxes, regulatory burdens, and the cost of capital, cost of credit, all declined. Animal spirits rose. For the next 2 decades, supply outpaced demand. Investment surged ahead of consumption. It was during this same period that inflation decelerated from its 14% peak in 1980 to the low single-digit rate that it was during most of the 80s and the 90s. So what made production capacity grow faster than consumption? The answer, cheap credit, lower taxes. The former lowered the cost of capital, while the latter propped up returns on capital. Together, they acted to raise companies' economic profits, which I think you guys all know the difference between return on capital and invested capital, or cost of capital. Nothing attracts competition like high economic profits. Entrepreneurs, highly predictable. When they see profit on the horizon, they'll invest, they'll hire, they'll build. Indeed, they did during the 80s and 90s. The unfortunate corollary, for those of you who've taken Greenwald, is that nothing drives down economic profits like competition. As more and more competitors invest in more and more new production capacity, yesterday's high returns become tomorrow's low returns. All this new supply drives down prices, which in turn drives down firms' return on investment. If returns ultimately disappear, or heaven forbid turn negative, businesses lose their incentive to invest and will shutter capacity. But the Federal Reserve has a powerful tool to combat the laws of nature. Since it sets interest rates, it has the ability to lower the price of credit, and hence the cost of capital. Consequently, with the click of a mouse from the corner of 20th Street and Constitution Avenue, the Fed can raise companies' economic profits, or more precisely, it once could. Sure enough, over the past few decades, whenever economic profits approached zero and investment dried up, or Washington feared that it might, the Fed simply lowered interest rates. By underpricing credit successively in this way, Washington enticed private capital to fund new production capacity that would not exist otherwise. As entrepreneurs' cost of capital became progressively cheaper, they could tolerate progressively lower returns on their investment and still earn a profitable spread above their cost of capital. Economic profit grew. Hear me when I say the past 3 decades have been a secular trend of declining interest rates and declining cost of capital, which means no one under the age of 52 has experienced a world with a rising cost of capital. If you forget everything else you've heard from me, this is why almost everything you hear from old people is irrelevant, because we don't know. We are so hardwired into this world. I can't seem to go backwards. I'll just give you the strobe light. We are so hardwired into a world of cost of capital doing this, most of us simply cannot fathom what the mirror image of that looks like. Another way that Washington encouraged companies to invest more in production capabilities was by significantly lowering tax rates and expanding corporate subsidies. This meant, again, higher profits, higher returns on capital. Between 1965 and 1982, the cost of capital increased significantly as interest rates skyrocketed. At the same time, companies' returns on capital were under pressure due to a stagnating economy and inflation. For this reason, economic profits were in a long-term trend of deterioration between 1965 and 1982. And as economic returns were falling, this discouraged entrepreneurs from expanding, which helps explain why investment in production lagged consumption during this period. This was inflationary, holding money supply constant, which it wasn't. But after 1982, when economic profits began expanding, this created a strong incentive to invest, which explains the subsequent long-term secular trend of investment in production outpacing consumption. This counter-inflationary force has been a great anesthesia to all the money supply growth over the same period. So this framing helps us understand how inflation accelerated in the 1970s and declined in the 1980s and 90s, even though money supply grew significantly in both periods. During the 60s and 70s, our government grew the money supply and enacted policies that discouraged production. But during the 1980s, 90s, and 2000s, our government grew the money supply and enacted policies that encouraged production. This trick worked well for 3 decades, which begs the question, why can't the Treasury, the Fed, Congress just keep on doing it? Can the Fed orchestrate a lower cost of capital from here? Can Congress cut taxes? Can Treasury, or our banks for that matter, or our consumers take on any more debt? I think not. For 2 reasons. Interest rates are already low, and ROIs are also low. In 1981, America's balance sheet was relatively strong, interest rates were high, and companies' ROIs were low. Supply-siders had a lot to work with. The country's balance sheet could handle a lot more leverage, and taxes were relatively high, which meant Washington could afford to lower taxes and endure years of large deficits. It also meant that financial companies could gear up and make more loans to entrepreneurs. Furthermore, U.S. interest rates were then at their highest level in 2 centuries, so the Fed had plenty of room to bring down the cost of capital. Now, 30 years later, we're at a different point. It's impossible to repeat the same tricks. With Fed funds at 0, the cost of capital is already near a floor. Thus, if economic profits are to improve from here, it's going to have to come from rising ROIs. The trouble is, the easiest route for most businesses to increase their ROIs is by shuttering excess capacity, which will allow for higher prices and higher profits. Furthermore, our nation's collective balance sheet is in a different place today. As you've probably heard, the ratio of U.S. debt to GDP is now twice what it was in 1981. Obama has moved into Reagan's old house, but now it's fully mortgaged, and worse, the value of the property has declined. Even worse, China holds the mortgage and is not excited about lending more money to a borrower so enthusiastically spending more than he earns. But enough prediction talk. Let's talk about what we can observe. Although the decline in consumer spending gets all the headlines, getting far less attention is the fact that industrial production is down significantly more. Both enjoyed big run-ups during the housing bubble, but after the pop in 2008, consumer spending is still flirting near all-time highs, while industrial production has plummeted. Other clues to aggregate capacity levels, such as real capex and private domestic investment, tell the same story. Supply has fallen significantly while demand has held up like a champ. Why are businesses cutting capacity? Simple. Their economic profits are declining. Once again, a surefire way for companies to now boost profits is by shedding excess capacity, and they are. Also, credit is growing for government. It's shrinking slightly for consumers. It's shrinking a lot for businesses. What I've done here is I've combined government and consumer debt. Those are the consumers in our society. And if you look at what the producers in our society are borrowing, it's down. Let me emphasize, though, that while total credit is growing, and by the way, I should emphasize that, total credit is growing. If you get into a deflation argument at a cocktail party, tell that to the person you're talking to. Aggregate credit in the U.S. has not gone down. But within the credit market, there's an important divergence that has implications for consumption versus production. As a percentage of personal income, government benefits have surged this year up to 20%. Think about it. For the first time in history, 1/5 of a U.S. household's disposable income comes from Uncle Sam. We are truly a changed society. Few appreciate that the welfare state that we all know, whether it's in Europe or the U.S., is a modern phenomenon. It's a post-1930s, and at least here in the U.S., it didn't become very large until the 1960s. And what this means is it puts a floor under demand that never before existed. This complicates comparisons of today with past deflationary periods like the 1930s. Losing your job or getting sick today is not like it was then. This should be the most surprising slide that you see from me today because when was the last time you walked into a Starbucks and saw this many empty seats? You know, New Yorkers may have lost their jobs last year, but it looks like they're still spending at Starbucks. So, at the same time that producers are losing their incentive to produce, consumers are resilient in their willingness to consume. Personal consumption expenditures are today at the same level as they were 1 month before Lehman failed and the financial crisis ensued. This is no accident. Uncle Sam has been hard at work encouraging more consumption. Mailing us checks is a surefire way to keep us in the malls. There are inflection points in history, and this is one of them. Every inflation on record over the past centuries has been preceded by government running budget deficits. Printing money is easier than raising taxes, and that's why every inflation has also been preceded by a growing money supply. For a brief period during the Great Moderation, this is the 1990s you're looking at, our money supply grew at the same rate as our real economy. This was truly a period of legitimate innovation. Real value was created, even setting aside the internet bubble. Not coincidentally, by the end of this decade, our country ran its first budget deficit in 3 decades. There was no pressure to grow the money supply. But then a speculative bubble on Wall Street popped, and then 9/11 happened, and then the housing bubble popped, and then the banking panic of 2008. Our government has used fiscal and monetary mechanisms to grow the money supply vigorously along the way. So, coming to the conclusion here. How can history help us frame where we are today? You heard me earlier make the bold statement that inflation is not in our future, it's in the present, we just can't see it. Now, I know it sounds madness to suggest that there's inflation today, and everyone knows that consumer prices are barely rising. Yet few stop to question whether the Consumer Price Index is the proper way to think about what inflation actually is. I would encourage you to think, rather than inflation as rising prices, think of it instead as the erosion of a currency's intrinsic value. If the US dollar is worth less tomorrow than the value of other things, then the value of other things will have inflated relative to it. Hence, a more reliable measure of the dollar's intrinsic value than CPI might include certain commodities, metals, foreign currencies, and judging from the appreciation of some of these alternative metrics relative to the dollar, we see that inflation arrived long ago. It was just hidden by the artificial growth of global production capacity. Inflations are not a new phenomenon. I said earlier, kings have debased their currencies for centuries to pay for castles and wars. And if you study past inflations, they all start with deficits, which leads to the temptation for the government to grow the money supply. The inevitable inflation that follows then leads the government to impose artificial controls in a futile attempt to repress rising prices. These market distortions have the unintended consequence of discouraging production. Shortages can then develop, which takes a mild inflation to a high inflation. So where are we today on this roadmap? Deficits? Yes. Money supply growth? Yes. Flawed policy response? More questionable, but I'd argue yes. The U.S. is pursuing a weak dollar strategy in an effort to stimulate exports. We're on track to impose price controls across the healthcare sector. We are posturing about raising trade barriers. We're even talking about certain forms of capital controls. Washington now has unprecedented influence over the nation's banks. Shortages? Not yet, but this bears watching very closely. It is critically important to understand that bottlenecks in just one single area can ignite broad price inflation. Even if most of the economy has a wide output gap, a supply shortage of just one vital item can spark widespread inflation. Such was the lesson of the 1970s. So today, there are areas that could be at risk of major bottlenecks developing, such as in energy and agriculture. We need to watch these areas closely. I think what's happening in India right now is very interesting. Some types of capacity, namely food and energy, simply cannot be conjured out of thin air. Bottom line, M and V is growing faster than Y, and that's inflation. Zimbabwe is certainly an extreme example, but it's a great case study from a conceptual standpoint. I encourage you to read what you can about the history of this very unfortunate hyperinflation. It has all the elements of what we've discussed today, though obviously on an extreme level. Deficits, money printing, price and capital controls, capacity reductions, and most importantly, shortages. So I hope at the very least I've spurred you to look at the subject matter from different angles. Inflation, while not yet visible in consumer prices, is here. It's simply hiding in the excess capacity that government baited into existence with the subsidy of low interest rates. We can observe that with economic profits now vanishing, excess capacity is shrinking faster than consumption. Add to this, we're growing our money supply briskly. The intrinsic value of our money is eroding, and that is inflation. All right.
Many hours more about inflation, output, and so on. I would invite you to take a look at that. Of course, it's exciting for me to participate in this because this is what I think about every day. So let me start by asking you a little bit more about these parallels to some of the past inflation experiences that we've had and the pressures that the monetary authority right now in the United States is facing. So you talked about this idea that there are these dangers and pressures on the Fed that are coming from the fact that, for example, we have this huge buildup in government debt. And there are historical parallels in terms of the effects that they can have. So, for example, you talked about the fact that that the U.S. going off gold was something that immediately followed a huge buildup in debt over the course of the Vietnam War. So one of the things that traditionally has been very important in the ability of the Fed to resist those kinds of temptations has been the institution of the Fed, the independence of the Fed, the ability of the Fed to say no to a request perhaps by the government or by others to create inflation. And so what I wanted to ask you about is, first of all, how do you think about how the institution of the Fed and the independence of the Fed has changed since this period of time that we were talking about, the 1970s and 80s? And also, recently there's been some new legislation which has gone in the direction of increasing the ability, for example, of the government to audit the Fed, and that you might think might go in the direction of making it more possible for the government to push the Fed around, and it potentially could be inflationary. So what do you think both about the comparison between the extent of independence of the Fed today versus historically, and the extent to which this might be changing over time now with these new legislative initiatives that for example, give Congress the option of auditing?
So just based on my reading of the history of the Fed, it goes in cycles. And this is why I go back to the mandate of people matters. Ultimately, no political institution is impenetrable. We have, as you know, had unprecedented independence of our Fed, and that, I believe, goes a long way towards the very stable conditions we've had for the last 30 years. The people woke up in 1982 believing that this Fed cares about inflation. So and by the way, Volcker in his memoir, which I think, look, there's a ton of books out there. In my opinion, read Volcker's memoir. It's called Changing Fortunes. I don't know that it's still in print, but you can get a copy. It's not too, actually I think it still is in print. But it's fantastic because, look, he actually lived through this. So he's not only talking about theory, he's talking about the raw execution of the Fed's policy. And he was involved, by the way, from the 60s on. So you get an on-the-ground view of what was going on in the 60s through the 70s and somewhat through the 80s. What's also cool is that he wrote the book with, I'm going to mispronounce the name, someone who worked inside the Central Bank of Japan named Gyoten I may be mispronouncing the name, forgive me if so, but every other chapter is Gayotin responding to what Volcker says, saying this is how we saw it on the other side of the world. Fascinating book. But Volcker talks about independence goes in cycles, and no Fed is ever completely immune. I think what's important to note is that just the fact that people are questioning is not a good sign. And you then have two types of people. One type doesn't scare me, and the other does. One is, look, I don't know the details. Maybe they have sinister motives, but the idea of wanting to audit the Fed to me is simply saying we don't trust that you aren't engaging in something called quasi-fiscal activities, or QFA, which is essentially a Fed acting outside of its mandate. And if you look at, Zimbabwe is a great example. I mean, the Feds can do really sneaky things that they're not supposed to do. So I think the notion of auditing, I don't have personally any opinion positively or negatively on who is this. This is Mr. Texas, libertarian guy. Yeah, Ron Paul. He's leading this effort. I don't have a strong view as to what he's doing, and I don't follow him closely. I just read the headlines. But I will say this. The idea that the Fed should be accountable, absolutely, I'm all for that. The people that scare me, though, are the ones that want to induce the Fed to print money. And I think, the idea that Nixon, I mean, it's almost comical to read what was going on, but, McChesney was a hard money guy, very conservative, and Nixon blamed McChesney for costing him the election against Kennedy. And so he had a personal vendetta against this guy. So the second go-round, Nixon finally gets into office, and I'll be damned if this guy isn't tightening again in the economy. We're going through a recession. So I actually don't know if his term was up. I'm sure that's what it was. But he replaces him with a friend, Art Burns. Now, they weren't buddy-buddy, but they were chummier than today. Like Bernanke is very careful. Like I think you may have read, he didn't want to go to the White House, or he wants to be seen as very independent. This was not what was going on back then. And it didn't look good that after Burns comes in, the first thing he does, is reverse his course and eases. So I think the Fed absolutely, if we've made a decision as a society that we want a central bank, and then we give them certain mandates, I think they should be held accountable, but they absolutely have to have complete independence to tighten, to ease, and I don't know specifically what you have to do to ensure that, but that's how I think about it at high level. I do think it's concerning, not so much the Ron Paul that we audit, but the fact that there are other voices that want the Fed to buy certain assets, that I think the constituents that are pushing for those asset purchases clearly have incentives that aren't in all of our best interests.
So does that play a role in your forecast, the idea that in some way the Fed might be more subject to these kind of pressures, or do you think that's something that's
I actually don't have a forecast. I mean, if again, look, I try to be dispassionate. I try to be a dispassionate truth seeker, and I want to track, I want to watch, and look, this framework hopefully is going to give you the methods to at least think about, are we seeing the Fed losing independence? I mean, right now, I don't fear that. At the margin, sure, a little bit, but I haven't read anything that scared me.
So second question, which is related in terms of this comparison versus the 1970s and also what's going on now, is the question of how inflation expectations play into all of this. So one difference between the 1970s and today is that in the late 1970s, people had just gone through this period of very high inflation. And so we talk about the idea that inflation expectations were unanchored. People had these very high inflation expectations, and that as a consequence, we had to go through this massive recession in order to bring inflation down. In contrast, in the present situation, we've been in a period for a sustained period of time of low and stable inflation over the Greenspan era and over the Bernanke period. And as a consequence, you might have more the sense that people really have an outlook of fairly stable inflation. So to what extent do you think people's inflation expectations are anchored at sort of a low and stable level And what do you think it would take to unanchor him? And what role do you think that issue should play in shaping up what our outlook is for inflation going forward?
So I think this is hugely important, and unfortunately there's basically no way to, there's no metric, there's no way to quantitatively look at this, but I think this is key, and because what I observe, first off, expectations of inflation matter with velocity. It's one of the more important things that determine how much money do I want to keep in my savings account, right? If I expect inflation, I want to buy that house now. I want to own hard assets. My behavior is very different than if I believe we're in a 2 to 3% inflation world. And so if you look at past inflations, there's a guy named Byrd who's written a lot on past inflations, and what he's noted in every single one is that there's actually two stages to velocity changing. And the first is in a mild inflation, which perhaps we're primed for right now. I think we are for a mild inflation. And again, when you hear me, I want to make sure I showed the Zimbabwe because I think it's a fantastic case study. I think if anybody's talking to you about the U.S. going into a hyperinflationary scenario, I personally don't buy that, and that has no credibility with me. I think there are going to be two stages to this. One is we get into a modest inflation. What's that? I don't know, high single digits. And by the way, as an investor, if inflation goes from where it is right now to high single digits, I mean, do you understand how much money you can make if you're actually running a portfolio expressing that view? That's, to me, that's all I need to care about. Is inflation going to go from 3 to 8, 9, 10? That's a modest inflation. Going to a high inflation, and again, academics use different benchmarks as to what constitutes high. To me, I kind of think of that as 20-ish maybe. Hyper, as you probably know, is what is it, 50% month to month or something like that. To me, just the idea of getting to high, the way you'll know we're going to get a high inflation is how the government responds to the modest inflation, right? If we have a Volcker come in, inflation goes up to 6, 7, Fed's independent, does what we don't like, induces recession, we're not going to have a high inflation. We start putting in price, capital controls, basically thinking that we can control the water, the dam with no consequences. That's what I would be watching for, but that's down the road. Anyway, so velocity, two stages. One is greed. So, and what's happening kind of right now, right? People are feeling good, man. Velocity's bouncing back. I mean, if you guys go home to your hometowns and talk to people, look, a lot of people are still out of work, but compared to a year ago, velocity's bouncing back. And historically, velocity changes really, really quickly. The second stage of velocity, where you get to a high inflation, is fear. Now, what I think's weird about today is, you go go and your plumber and dentist friends are talking about buying gold, and I mean, so you made the point that, hey, people are really primed because we've had 3 decades of low inflation, so therefore expectations should be low inflation, we've got a great Fed. I mean, go talk to people in, the middle part of the country. I mean, people that read the papers and are educated and think about this stuff, that aren't practitioners are terrified of inflation. I think arguably too much, perhaps, but they see the M0 where it is. They see. I think people are so primed for inflation that if we actually get some inflation, I actually think expectations could change very quickly. Now, what you don't have now is, I mean, unions used to be 30% of our workforce back in the 70s. I didn't go into this, but I think it's less than 10. Now, granted, we just had the first uptick ever since the last few decades. We just had the first uptick in the last several decades since the 70s in union membership, but it's all public service. None of it's in the private. So you don't really have the wage pressures in non-government labor that you had today. That's good. So the second thing, I really hit all my points.
So one last question. So I think there are two kind of major defining experiences with inflation and major macroeconomic episodes that we all think about when we try to think about what's the right policy for the U.S. to have. One of them we talked a lot about, which is the great inflation of the late 1970s and early 1980s. And this was a period in the 1970s when the Fed really let inflation get completely out of hand. The other experience was the Great Depression. And this is a period where, to a large extent, we think so I think these are two of the defining events that we think of as shaping how we should think about what policy should be today. And certainly, the current administration has emphasized a lot the experience of the Great Depression as something that we want to avoid. And this has been one of the motivating factors in the monetary policy that we see, is trying to avoid the types of things we saw happening during the Great Depression, extended depression while unemployment and of course deflation.
Mm-hmm.
So to what extent do you think the Fed has done a good job in terms of walking a line between concerns of inflation that you're talking about associated with a combination of very loose monetary policy and growing debt and so on, and the types of concerns that we might think about when we think about the Great Depression of possibility of deflation and a much more protracted recession?
Yeah, no, I actually had some notes. The Great Depression is such a complicated area, and there's a huge body of work on it. So I'm going to try to give you my big picture view without getting into, start talking about the Great Depression, you'll get into debates with just about anybody. But to me, the issue with the Great Depression, the simple ones, is number one, we couldn't print back then. And number two, the Fed did not have a mandate to do what it does today. It's important that we understand that the Fed has evolved substantially over the last, since 1913. And we've, initially the Fed had one job, and that was elastic money supply, right? Lender of last resort. That's it, right? Then we had a book that changed the world, General Theory, right? I mean, that really didn't change the shape of the Fed even beginning until the 40s, and then you started having debates about, well, maybe, we should be activist and try to, soften the fluctuations in the economy, and we should be activists with interest rates, and that was not even in the Fed's mandate at that time. So I think to criticize the Fed back then is unfair because they were kind of doing what they were supposed to do. So today, what do I think of the Fed today? That's a loaded question. This is the good thing. Bernanke certainly gets it, and we've had guys in there who didn't get it. I didn't really spend, for sake of brevity, which I know I didn't give you, in the late 70s, we had for 1 year Fed chairman. It was awful. I mean, he was literally there for 1 year, and they booed him, you know this. But it was, so you can have bad Fed chairman. Bernanke has, there's nothing he doesn't get about depression. He's a monetarist, basically. He gets what's going on. So I don't question the guy's integrity. I don't question his intelligence. I question his confidence. And I think a study of history would indicate that, look, even back in the 70s, Burns was not a dumb guy. These are not dumb people. And it shows that, what is the Fed's job today? Okay, lender of last resort. Maintain, essentially, 100% employment, right? And essentially smooth out don't allow recessions. That is a really hard job. Look, I work in the hedge fund business. I don't know a single guy I'd trust to do that, right? I know guys that are really smart, that have great integrity. Now, that's personal. Now you're going to force me to talk a little bit political, but I think a question that we should ask ourselves as a society is, do we want one person or organization to have the power to control what I believe is the most important price in the entire economy, and that's the price of credit. And that's, if we've decided as a society we want that, I think Bernanke's a good guy to do it. I think he's the best guy in the job that we could have for the job that we've given him.
It's a tough job.
I wouldn't want it. And look, yeah.
So let me ask you just as a last question. We've been talking about it at a very high level about macroeconomics. So let me ask you lastly, since you interact a lot with people on Wall Street, you talk a lot to investors and so on, and you talked a little bit about the idea of connecting this type of thinking with what we do in finance. Can you talk a little bit investing. What are the key ways in which you think that should affect someone's outlook as interested in finance?
I would just say that, look, every one of us and pretty much everyone we all know professionally and all the people we have worked for and have lived in this world. I mean, this is really weird, and none of us know it's weird. And I didn't know it was weird. I mean, look, I'm a bottoms-up stock picker. I'm a value guy. And in early '08, I started studying banks. Because banks were cheap, and a lot of prominent value guys were saying, so once-in-a-lifetime opportunity to buy banks. So I figured, okay, time to learn banks. And as I started learning about banks, I was able very quickly, if any of you guys are fundamental equity guys, first thing you do, what? You study the industry, right? Well, if you're going to study the dynamics of the supply and demand of the industry, what's that in banking? It's credit. So I got to do what I've been wanting to do for probably 10 years, and that's spend some time analyzing the government or the macro U.S. just like I would a company. What are the revenues? What are the expenses? And so forth. And it just dawned on me that, my God, we have been in the weirdest period in the last 100 years. I mean, by the way, only time the world has ever been on a global fiat currency. So everything we know, I argue, I mean, anybody that's coming out of school, like if I get a 22-year-old, I'm like, don't listen to anybody. Like everyone has only grown up with this downward sloping interest rate. Cost of capital has been declining. So I'll say this, Michael Steinhardt in his book, No Bull, talks about in 1970 or 69, there was an article in Fortune or Forbes that listed the top 10 hedge fund managers. And a decade later, only 3 were still in business. All right? And you'd think that the 1970s should have been the ultimate period for a hedge fund to prove itself. And my take on it is that most hedge funds then, as probably now, are extrapolating the past. And if you took the 50s and 60s, I hadn't spent a whole lot of time in the 50s and 60s, but they probably don't look a whole lot different than the 80s and 90s. That extrapolation, right? Guys have gotten really rich over kind of doing something for 20 years that just extrapolated into the future. I think most hedge funds are set up today in that same way. I don't want to step on toes. I'm very bearish on the traditional large mutual fund business. The influx of capital from banks to Fidelity, my prediction, you're going to see a huge reversal of that. Oh, in a world where interest rates are rising, stocks will not do well as an asset class. Bonds, long-term bonds, obviously, do not do well. So you tell me as a saver, where are you going to put your money? You get your Fidelity statement, your long-term bond fund, which you moved all your money to because your stock fund was down last year, now it's all in long-term bond funds, that's down 20%. And you look in the corner bank is paying 5, 6, 7% for a CD, which will be the interest rate that will take your Fidelity statement down 20%. I think you see a generational shift back towards banks. And look, when I got out of college in 1990, I got on the phone cold calling from Merrill Lynch. I was a stockbroker, and it was like taking candy from babies. I mean, you call people that had bank CDs, paying them 3%. They had gotten a 50% pay cut in their incomes. The people that lived off that interest. I can put them in a 5-year treasury and double their income. A whole generation flooded out of CDs and went back. I went to Wall Street. So my big message is, what does this mean? Extrapolating the last 30 years is the most dangerous thing you can do. I throw out, the quants, right? Most guys that are doing quantitative strategies are data mining the living daylights out of data that in most cases, unless you're at Renaissance, are back to 1988. Seriously. The S&P point-in-time data, which everybody's using, is really a weird period of time to be data mining and extrapolating into the future.
Right. There's an interesting parallel actually to academic economics here because, the field of economics went through what's called the rational expectations revolution. Robert Lucas won a Nobel Prize for it. And this is sort of exactly what it's about. You know, the question of, can we look at a period, particularly a period which is as unusual as it has been, and can you really extrapolate it forward, given that, you know, we might very reasonably think that some of the policy changes and so on that we've seen are going to lead to a future that looks very different from the past.
Yeah. And I mean, look, it's markets are back up, and you know, everybody thinks, for the most part, things are okay. I mean, step back. Did we just borrow a lot more money to fix the problem? Seriously.
Okay, great. Yeah, thank you very much. Now let's open the floor for questions. Yes.
Just to follow up on that question, you mentioned areas where you wouldn't want to be. When you think about where you put capital today, because there's a lot of inflation.
I think it's tough, and I'm not going to lie to you. First of all, if you're out there, yeah. So if you're doing, I mean, I can't give you financial. You know, here's I'll tell you what I'm doing with my money, right? Which, by the way, this is not industrialized. Look, I've got my 5 to 6 stocks that are lifers that I think are great businesses. And this is the kind of stock you want in this environment. You want high ROE. And by the way, let me tell you what I'd avoid with stocks. Large, well, I'd avoid index funds, and I'd avoid closet index funds, which is, you know, that's 95% of the mutual fund industry. If you're going to give money to mutual funds, give it to people that are actually managing money, picking relatively concentrated portfolios. And you know, you guys know who these guys are. Your value investors, you know who these mutual fund guys are, right? There are guys that are really picking stocks out there. I think this is a stock picker's market. But how many places can you put your hard-earned savings with a guy that's just going to pick 20 to 30 stocks? I mean, I can probably name 10 mutual funds. Now, avoid stock funds for the most part. Avoid index funds definitely. Pick 5 stocks, high ROEs, relatively high dividends. Buffett wrote an article, you can Google it and find it, I'm sure, back in the late 70s, where he talks about, I mean, there's this popular notion. I mean, if we walked around the corner to some restaurant and we took a poll, I don't care whether it's a dentist or a plumber or an investment banker, the 2 biggest myths in my mind that America has are that stocks go up 10% over the long haul from any price point, which is, I mean, you laugh, but you're laughing at me up until 3 years ago. And secondly, that stocks are a good inflation hedge. I mean, I love that one. Like, I promise you, inflation goes, if it goes from 3 to 6, 7, 8, 9%, your stocks are going down, and they're going down probably a lot. I don't think the average American gets that. But Buffett wrote an article back in the 70s where he actually talks through in a pretty thoughtful way. Now, I'm curious if I could get in front of the guy to ask him, because I have him in print now saying that I'd rather own stocks for the next 10 years than bank deposits. I mean, in the same breath, he's writing in his letter that he's predicting inflation, and I have spent a lot of time thinking about this, mapping it out. I don't know how you can make that happen. Now, I agree. I'd rather own 10 good stocks than, which is what he's doing, but I would not be telling America to put money in an index fund over the next 10 years. If you think inflation is going from 2 to 10%. Same goes for long-term bond funds. Ironically, if you look at total fund flows, money has simply gone out of stock funds and gone into mutual funds. It is not, for the most, some's gone back to banks. But for the most part, the mutual fund industry is doing great. Commodities, I think it's tough, right? I mean, you guys, if anybody here is a commodities guy, I'm not, but it's shocking that, you know, if you had predicted sugar was going to double, you nailed it. But you rolled the near future, you lost money. The cost to carry is so out of whack with ETFs and commodities, I think it's tough. Now, you can do metals, but the way to think about metals, to me, is not as a speculation, but as an alternative currency. There's a guy named David Einhorn, some of you may know who this guy is, and I can't say it any better than he does. People, I think, have this misperception about gold, that it's a speculation, that it's, you know, it's the ultimate greater fool's investment. It has no intrinsic value. It's flawed. The way David puts it is perfect. Gold is simply a currency. That's all it is. It's a store of wealth. So you don't ask yourself what's the intrinsic value of gold. You ask yourself what's the value of gold relative to $1. And look, 10 years from now we have twice the number of dollars. I promise you the intrinsic value of that gold has doubled. You know, you get my point? So that's gold. look, you can do things like caps. There are derivative type contracts. These are not secret. You can search. Julian Robertson's talked a lot about this in the press. Unfortunately, these things are expensive now. A lot of what's very expensive is the inflation insurance trade, and I have only been engaged in my work for the past year to study I've designed a framework that tracks a ton of metrics. So we're trying to set this up where we can track things and look at them monthly or quarterly and see if red lights. But I haven't tried to express inflation. But if you talk to your trader friends that are actually pricing this stuff, they'll tell you. I mean, the long-tail insurance is really expensive right now. I'll tell you what's probably a cheap way to do it. Maybe is to short long-term bonds, but I haven't done that personally. So what am I doing? I have gold, I have silver. I think silver is probably better than gold, and I have my 5, 6, maybe 7, 8 with little positions that are great businesses. I think a little more specific, I think small commercial banks with great balance sheets that are not too small, but kind of in the 500 million to several billion, actually I'd say $1 billion to a few billion, are going to do very, very well if they're very well capitalized over the next 5 years. That's my bet.
Two-part question. Do you think that these types of policies of printing money to keep supply going up are widespread throughout the world? And then specifically, is a system like the euro susceptible to this, where they can't really print money to fund budget deficits of the government?
Well, and I want to be technically correct for the economists in the room. Printing money, some people would say that's QE, so the whole notion of QE is a little new. But money supply growth, which is kind of tempting the banks to go out and grow. Yes, so to answer your question, the world went on a fiat currency once, essentially, or shortly thereafter, Nixon broke the gold standard. We had been, everyone was pegged to the dollar, theoretically, and the world's on a fiat currency. So the question to me, this is why I don't like the negative dollar bet, because I don't want to necessarily bet against, I don't want to say that the U.S. is going to misbehave necessarily worse than certainly the rest of the world in the aggregate. Now, I think there are certain countries out there that are behaving better, so those could be interesting plays from a currency perspective longer term. I'm not a trader. But no, all central banks have been growing the money supply, and I'm absolutely convinced, they're all sitting down in places like the Metropolitan Club with their, brandy and cigars, and central bankers around the world, and they have these little meetings, and what we want is we want to inflate in a coordinated way, because like it or not, it is the easiest way to get out of this credit situation that we're in. It's the easiest way. I'm not saying it's the morally righteous way, but it's the way that they would like to do. The problem is, the problem is how do you keep people from cheating, and China doesn't want to do it, so obviously it's tough. Did I answer your question fully? Yeah. Okay.
So can you talk a little about real estate as a hedge, as an inflation hedge? Because when I think about it, I think that if the borrowing cost goes up, then real estate prices will come down.
Sure.
So to me, if there's inflation, I would say, well, real estate prices will come down, and then of course.
I think that's a great point you bring up. I don't mean to cut you off. Sorry.
I was going to say, then of course people say, well, rents are going up, and that's the hedge.
Yeah.
But that's the same thing as a production company, where the price of goods that they sell is going up. So that's the difference.
Well, here's the problem that screws up real estate. Is number one, it's mostly financed, and for the last, I don't know, correct me if you know differently, but the last 20 years, we've essentially socialized mortgage loans in this country, right? I mean, if your bank writes you a 30-year fixed mortgage, I promise you they're not going to hold it on their balance sheet. It gets sold off, and that's been the way it's been for a long time. They want to hold the variable because they don't have the duration risk. But in the case of real estate, what's tough is that it's been inflated with this cheap credit like everything else. So have you been able to buy? Has the price of real estate been intrinsically, where it should be, absent the subsidy of cheap credit? Absolutely not. So I'm making the assumption everybody here's a value investor. What do you want if you're a value investor? I want to hunt where nobody else wants to be, or no one else can be, right? So clearly, there are going to be really interesting things to do in very distressed real estate over the next 5 years. I'm not a real estate guy, but I can tell you the big real estate moguls that we know today, built their fortunes in the 70s. So, you know, I'm personally, I'm saying I may go down this road. If I had a clean slate, I'd want to be spending my time learning about real estate, because at some point, when these banks are forced to spit it out, we just haven't had a cleansing yet, right? I mean, you guys know this math probably, so forgive me if this is too simple for you, but the average bank in this country has roughly, what, 5-6% equity to assets, okay? And then the average bank has roughly 40% real estate, ballpark. You know, it's not hard to kind of roughly know what the real value of that real estate is based on the secondary market, because all these real estate loans are carried at what they were written at, several years ago before the crash. So economically, the average bank in the U.S. is bankrupt, right, economically. But it's forbearance. We're going to, let them earn their way out of this hole. And guys like me, I can't get a bank charter. I'd love to go in the commercial banking business right now. Can't get a bank charter. No new entry. We're letting these guys work their way out. So to answer your question on real estate, I think there's going to be really cool stuff to do in real estate. Unfortunately, I'm not the guy to ask. And but I agree with you. Right now, would I want to be making the bet that real estate is cheap right now? I don't know. I mean, the problem is none of the banks are being forced to sell this stuff yet. So I think there are bids out there, just nobody's taking them. But again, I'm not the guy. Ask. I think that's what you'll hear if you talk to people that are real
Just
estate.
to follow up, when people say that real estate's an inflation hedge, I don't see real estate very different than a large production company. Where you have
let's go back to a world where it's a free real market with real estate. It's not inflated artificially. Is it an inflation hedge? Of course. I mean, look, you got your cost of, I don't know if you ever owned a house, but you get taxes.
Excuse me, I'm afraid we've got to wrap up. Somebody is meant to be in this room at 7 o'clock. So, another space.
This is my email if anybody has any questions. Looks like this must have done.